Okay, this is Dennis Lindsay with Corcoran Global Living. I'm here again with my good buddy Kyle Rush with Guild Mortgage and on our monthly mortgage.
Hey,
So
Dennis.
Kyle, I'm going to ask you a question about loans and servicing loans and things like that. Do you guys service your own loans?
Yeah, great question, Dennis. Guild Mortgage services roughly 90% of the loans we write. So, the bulk of our business is business that we will retain through the life of the loan and collect payments on that debt. Now, to put it in scope of what servicing is very much a custodial aspect of the mortgage. We have to keep in mind that almost all mortgages in the United States are owned by Fannie Mae or Freddie Mac. And so they allow mortgage companies to service that debt for them. In other words, Fannie Mae and Freddie Mac are investors. They don't want to deal with the general public. They allow the lender to deal with the general public. We collect those payments. And then our job is to make sure that we divvy the payment up and pay out property taxes, homeowners insurance, and that we send the principal and interest for that payment to Fannie Mae and Freddie Mac. And that's how the custodial aspect works. Really, the only loans that we know we're going to have to sell are when we work with programs like the Nevada Rural Housing Authority or the Nevada Housing Division. Those loans or grant programs all require the same master servicer, which is US Bank. So very rarely will we let the servicing rights go. And if it is something we are originating, we can tell you right off the cusp whether or not that's a relationship we're going to be able to continue to service or something we have to release to another lender.
So, all right. So let's say that I'm a consumer. I get my loan through you guys, lender A. And all of a sudden I get a notice from somebody, I don't even know who it is. And it's a lender saying that we're going to be taking over that loan. Why does that happen and how does that work?
Yeah, great question. So there's two reasons. The first one is that mortgage companies, when they go to close loans, they set themselves up to either be a servicer or a seller. And the idea is that there's another aspect of income that comes out of servicing loans. In other words, Fannie Mae knows that if they've got someone servicing that transaction for them, they've got to pay them in some way, shape, or form. And so as a servicer, what we get is you typically receive about 1/4% of the interest that's paid on that loan. So Fannie Mae allows the lender to keep a very, very minor portion of the interest that accrues every month for servicing that loan. So in theory, you've got to have a operations center or a servicing department that's capable of managing the amount of deals you have. And then you have to have enough servicing rights or loans that you're collecting payments on to be able to operate and pay that division. So some mortgage companies look at it and say, it's just not worth us employing X amount of people to take phone calls, pay taxes, pay insurance. We would in turn rather sell that to mortgage company XYZ and allow them to collect those payments. Guild Mortgage has set ourselves up to be a very large servicer. And our goal is to grow that servicing portfolio into a very, very large amount. We're hoping to get upwards of $90 billion worth of servicing rights, which to put that in scope would probably be upwards of 500,000 home loans that we're collecting payments on, which means we have to have multiple servicing centers around the United States capable of answering questions, processing payments, paying taxes, paying insurance, and then remitting the principal and interest to the investor.
Wow.
So a lot of it kind of depends on how the company is structured, whether you want to employ that division, have some residual income, or whether it makes more sense to just let that loan go and make a lump sum payment for it.
I see. Yeah, good. That's a good answer. Question on interest rates. Are we seeing any movements on that, or are they being consistent?
Great question. So right now, the key driver in the market for interest rates is really the Federal Reserve. And so we have to understand what the Federal Reserve is watching, because the Federal Reserve is stimulating the market. And they've been doing this for about 1.5 years since the pandemic started back in March of 2020. The Fed stepped in and have been buying Treasury bonds and mortgage-backed securities. And the reason they're doing this, Dennis, is we have to kind of think about this as an investor versus a homeowner, right? As a homeowner, I want the lowest possible interest rate I can get. For my clients, I want them to have the lowest possible interest rate they can get. When interest rates dipped to that all-time low back in the early stages of the pandemic, what we saw was there was no appetite for investors to buy that debt, because now we're saying, hey, you've got hundreds of thousands of dollars that's paying you back at 2.5% over 30 years. That's not a very attractive figure to an investor. So the Federal Reserve jumped in and said, we'll buy it. We'll take that debt on. And they've been doing that since March, April of last year. Now, an important thing happened yesterday. We received the minutes from the Federal Reserve meeting that ended at the end of July. And in that Federal Reserve meeting, the feds used certain verbiage to kind of forecast what their plans are. And one of the verbiage that came out of that meeting was that they anticipate tapering their spending down on mortgage-backed securities and treasury bonds by the end of the year, which means if they do that, interest rates will go up as they reduce their spending. Right now, the reason they're not doing it is mainly because of the Delta variant of COVID and what it's doing to escalate infections and hospitalizations. The other two metrics the feds are watching are unemployment and inflation. And both of those are real close to the goal mark that the feds had to start tapering their spending. The variable became this Delta variant of COVID. As we continue to see infections rise and hospitalizations rise, interest rates should stay lower. If those start to decrease and we start to get to the light at the end of the tunnel, interest rates are going to go up.
Okay. Well, guess people better refinance and buy, huh?
Yep. It's the time
That's
to
what we're
do
looking
it.
for. Yeah.
It makes a huge difference. These rates are something that we are only seeing because of a pandemic. And I think you and I agree. Hopefully we never see that again in our lives.
Yeah. Yeah. Good. Kyle, if someone wants to get a hold of you, how do we do it?
My name is Kyle Rush. I'm with Guild Mortgage. You can call me at 775-885-6892. My NMLS number is 35359-230. Thanks, Dennis.
Good. Okay, guys. And we'll see you next month. When you guys get this, please share it. This is some good information from Kyle. Talk to you next month.